record.
Yeah, I'm gonna not record. Hi, so I know people are starting or entering from the waiting room here for the webinar, and we'll begin in a second. Hi, this is Mike Bergmeyer, one of the managing directors and co-founders of Whipstitch Capital, and thank you for joining us today. We have several people who are going to present today, my co-founder Nick McCoy, and then the three VPs from Whipstitch Capital, and our stitching crew member, Rico Arena from Spins, will also be joining us. Just give you a little overview of what we'll be covering today. We will have a 30-second commercial just talking about Whipstitch Capital and who we are. And then for the first time ever live, we are going to go through our top 11 healthy living consumer trends. As people may know, we usually put out this report that we're going to be going through today a few days before the beginning of either Expo East or Expo West, but clearly this is not your traditional year and there was no Expo East. But we wanted to put out the report and keep showing what we're doing and share the information that we have with the broader community. So we thought we'd go ahead and kind of do a live presentation of this report today. The report that we're going to be going through is actually a condensed version of the larger Healthy Living report that will be available on our website later on this evening and tomorrow as well. Everyone who has signed up for this webinar will be receiving an email as a follow-up with a link to this report, and our entire database will also be getting a copy of this. In addition, after we go through as a team the top 11 trends, Enrico will provide again, just a snapshot of what the full report is, but some information and industry analysis and data that Spins has put together for us. And then we're going to try to use some Q&A today too. So please use the chat function on your Zoom and you can ask questions. And our goal today is we've reserved an hour. We're going to try to go through this relatively quickly in about 45 minutes or so. We'll see how it goes. And then try to save as much time as possible for Q&A. In the larger report that you'll get tomorrow, there's also a section that has a lot of data on the deal review. And so basically looking at the capital markets over the last 6 to 8 months or so in terms of data and information on M&A and then private placements as well. And just some broader information as well. It's too much to go through in about 45 minutes today. So that is what we'll be going through. And so just a little bit on Whipstitch Capital. Whipstitch Capital, we celebrated our 5th anniversary yesterday, so we're very excited here. We are the largest independent investment bank in the US that is solely focused on the healthy living market. And a picture of the team here. We've all been working together for quite some time and love what we do. When Nick and I started Whipstitch 5 years ago, we aimed to create something different. We did not want to be a traditional investment bank. We wanted to be the best investment bank possible for our clients in the better for you consumer sector. And we are pretty different than a lot of other banks out there. First of all, we own Whipstitch. Nick and I own 100% of the firm. We're not going anywhere. The VPs have all been with us, working with us, usually prior to Whipstitch. So we've got a lot of continuity with the team. We're highly connected in the industry. We know virtually every acquirer, investor out there, regularly interact with all of them too. All we do is consumer. The whole team, this is all we do. We think we know it better than anyone. And when you engage in investment bank, it's important that your partner know how to talk about you and your opportunity. And we're here for the long term. We work with many clients over a long period of time. We have no quarterly quotas. We look to do the deal for you at the right time to maximize the best outcome. And we lead a lot of industry gatherings, usually in person, but there's a reason why today I'm wearing my gym shorts with my disguised good shirt, because we're all on Zoom, working from home these days. But we hopefully can bring some people together here, and we're looking forward to getting back to we can actually see everybody in person. A little bit of the team here, and we'll just keep moving on. Today, though, actually, no, so it's kind of some of the deals that we've done, and you can see more information on some of our clients and the transactions we've done on our website. I won't go through that right now. So today, you'll be hearing first from Nick McCoy, and then the three VPs at Whipstitch will be going through some of the trends as well. And then you'll be hearing from Enrico as well. And with that, we'll move forward. And for the first time live, we have the top 11 healthy industry living trends. And take it away, Nick McCoy, for trend number 1.
Thanks, Mike. So I think by now everybody knows that COVID has driven us into our houses and changed a lot of our patterns of living. One of the things that we've seen is not only are people eating more and cooking more at home, but when looking at the data and also anecdotally, people are gravitating toward healthier foods amidst the indulgence that they're doing too. Next slide, please. So looking at the data, if you look at the chart on the left, it takes a little explanation here, but TPL is Spin's entire universe of all the companies. HWI is the 25% or so most healthy. NPI is within HWI, the 1/3 of that, or 8 or 9% of the total, which is the healthiest. Each bar represents a month. February is on the left and July is on the right. So you can see what happened in March. Sales went way up as everybody pantry loaded, and then they kind of correct a little bit, only to flatten out. What's significant about this chart, though, is it provides evidence that people made a conscious switch into healthy living right away, because the HWI index has over-indexed in this chart starting in May, and when you actually back out the impact of convenience store sales slumping in March and April, and how that impacted energy, which is in this, it actually started over-indexing right in March. And it's really interesting to see in the data that people are making that move toward choosing healthier foods, partially as a result of COVID. And we also think because millennials were forced into the grocery store more as Instacart and other things stopped delivering. It's also interesting looking at the chart on the right that we've got a longer term trend. This is actually over 4 years or 3 years, that private label organic and actually private label categories that have organic are over-indexing as well. Private label organic over-indexing the private label, excluding it organic. Fun fact, in the last 3 or 4 months, private label in total has actually dropped a percentage. More evidence that people are moving toward better for you brands. Next slide, please. So while we're home, what else is happening? We're eating more and we're cooking more. And we're seeing that products that are used in home cooking are over-indexing, continuing today. Next slide, please. Looking at the chart here, some common categories of home cooked items. You can see spices and seasonings are still very, very over-indexing compared to everything. Grocery store visits are still down. People are buying more though. So you still see carts that are more full. People aren't just going for 1 or 2 things. That trend started in March and it continues today. And we tried to find some great predictions on, how is this trend that we showed in the previous slide of over-indexing, kind of, grocery store sales being higher. How is this going to continue in the future? And it's really hard to find data. But what we did find, and I think this is extremely conservative, is that by the end of 2021, the grocery sales will have taken 5% of restaurant sales. The reason I think this is really conservative is if you look at government data, 1 grocery store dollar is 50 cents of restaurant dollar. So in other words, it basically costs you twice as much to eat at a restaurant as it does to buy groceries. So if you think about the fact that we're 12% or so above where we were in February now, and they're talking 5% restaurant, that's only 2.5%. We're not seeing that grocery line drop. It's very, very stable right now. So for it to move from now to that 2.5% at the end of next year, it has to drop a whole 10%. And right now, based on what we're seeing, it's hard to fathom it's going to go down that much. Next slide, please. So what other trends in the home? Frozen is hot. Frozen has been elevated since March, and it makes sense because if people are going to the grocery store less, they're going to be filling their freezers so that they can stay between visits much longer at their house. Next slide, please. So what does this look like in the data? Well, you saw the previous chart 2 slides ago where we showed how things went up in March and then came down and then flattened out starting around May. What's really interesting about frozen is frozen went up in March and it came down, and instead of flattening out in May, it's actually stayed at a high over-indexing level. You can see on the right here, we're still at 27% in HWI versus 20. It remained at a very over-indexing level and kind of petered down. And I think that gives evidence of a couple things. One is that there were a number of stockouts in frozen. And anecdotally, I can tell you I saw that, and I'm sure others did too. The other thing is, I don't know if anybody's tried to buy a freezer lately, but it's very, very difficult. So the fact that you're seeing that line come down slowly gives evidence that people are now just getting freezers that maybe they ordered 2 or 3 months ago, and you're seeing people stocking those, particularly as we possibly might be entering a second wave here. And now I'm going to pass on to Dominic.
All right, thanks, Nick. So in addition to the types of products that consumers are purchasing as a result of COVID, we also want to spend a little bit of time talking about the ways in which COVID has influenced the shopping habits of consumers. So our fourth trend today is how new consumer shopping habits are driving an increased adoption of grocery delivery. So if we think back to 6 months ago when we were all beginning to hunker down and find ways to avoid leaving the house, it's not too surprising to see that online grocery delivery saw a significant uptick as a result of COVID-19. However, what has been really exciting for us to see in the data is the extent to which consumers' use of these services has remained incredibly sticky. So whether it's Instacart, Amazon.com, Walmart.com, or one of the other grocery delivery options out there, it's clear that a large portion of the population trialed grocery delivery for the first time over the last few months, and subsequently has continued to use these services as they preferred the ease and convenience of doing so. And subsequently, through this kind of change in consumer habits, the data we see in the market is that the online grocery market is on track to more than triple this year and equate to about 10% of the overall grocery market. And with such significant growth going on, and when we think over the next 5 years where this trend could lend itself, we're seeing that the online grocery industry could become over 20% of the overall grocery market, which really will have some significant implications for all parties of the grocery landscape. So for instance, we're already seeing retailers begin to repurpose or modify their stores to account for this significant increase in demand of online ordering. Emerging brands are becoming more and more proficient with their ability to drive brand awareness through direct-to-consumer marketing tactics, which would be incredibly important as these virtual storefronts become more prominent and the ability to drive brand discovery as consumers walk down the aisles becomes less and less prominent. And lastly, strategics. And if strategics weren't taking e-commerce or online grocery all that seriously prior to COVID-19, I think these last 6 months have proven that this is a key trend that they need to put at the top of their priority list. And in our conversations with strategics, it's been very apparent that they're either trying to develop these capabilities internally and or acquire them. So all in all, there's been a massive shift in consumer preferences when it comes to ordering groceries online. And from everything we can see in the data and what we're hearing in the market, it's pretty obvious that this trend is here to stay for the long term. And so in addition to COVID, we've also seen a tremendous amount of social activism over the last few months for critical problems that we face as a society today. So whether it be systematic racism, gender inequality, or just the increasing concern for the environment, we wanted to spend just a little bit of time today talking about how consumers are increasing their efforts to purchase products of mission-driven and socially active brands. At a high level, how we're thinking about this trend is that more than ever before, consumers are now demanding and asking brands and businesses to take stands on these matters of social equity and environmental concern, and subsequently are rewarding brands for doing so. So how we're thinking about it internally is that effectively consumers are voting with their wallets to support these matters, support these causes by effectively purchasing products from brands that are taking a stand and attempting to drive change. So for instance, if we look at what Ben & Jerry's accomplished this summer when they took a powerful stance against the continued racism we're seeing in society today in support of the Black Lives Matter movement, what was very interesting is that during these months of June and July, they saw an outsized level of growth in their business year over year relative to all other large ice cream brands in the US. And we believe this data point is a clear demonstration to the extent that consumers believe one of the more immediate and impactful ways to support various causes like the Black Lives Matter movement was to continue to buy products or ice cream from Ben & Jerry's. Now, in no way, shape, or form are we saying that Ben & Jerry's or any other brand are trying to leverage these social movements to drive sales. But what we're really trying to demonstrate is the extent to which consumers are asking brands and businesses to support these causes. In addition to Ben & Jerry's, we've listed a few brands here on the right that we think are doing a similarly strong doing a strong job of partnering with social causes and doing it in an authentic manner. And if you own a business or a brand and are similarly trying to find a way to align yourself with one of these causes, we highly recommend you take a look at what these brands are doing. So I'm now going to pass the ball to Greg Usich, and he's going to talk about the exciting world of cannabis.
Thanks, Tom. For those of you who follow cannabis, you know very well how challenging operating in the cannabis industry can be. And it's probably stemming from the fact that they're trying to sell a drug that is considered a Schedule I substance from a federal level in the US. So it was a really great breath of fresh air when we found out that cannabis companies received essential business designation earlier this year. So when you look at the retail sales data in cannabis, you actually see a pretty similar trend that you saw outside of cannabis. So when March came around and COVID hit, everybody rushed to the dispensaries to purchase their cannabis products. And then over the course of the next month or so, they worked through the inventory in their homes. And then you see a pretty good increase in sales for the following months. And I think it's really important to remember that cannabis is a massive industry. If you look at California, just as its own state, they're actually generating $80 million of revenue every single week from a retail sales perspective, which is equivalent to $4.2 billion a year. And just for some context, if you look at Coca-Cola's Coke sales in Milo for the last 52 weeks across the entire US, that's actually under 4.2 billion. So California cannabis sales through the retail channel are larger than Coca-Cola. And a lot of folks who follow cannabis predict that only about, call it 20 to 40% of the retail sales that are tracked in California are reported, and the rest is sold through the illegal market. So if you look at that $4.2 billion number, there's a pretty good, there's some pretty good basis to assume that that number is actually a lot larger. And what we've seen is some of the large multi-state operators, which is just cannabis speak for companies that have licenses to sell cannabis in multiple states in the US. They have reported some really significant earnings, especially in Q2 of 2020. So if you look at three of the largest, Green Thumb Industries, Curaleaf, and Cresco Labs, they have not only been able to increase their revenue quarter over quarter, but in Q2 of 2020, they all generated around 40% normalized EBITDA margins, which is really reassuring. So to recap, cannabis is large, it's growing, and we're finally starting to see some of the US operators generate some really significant EBITDA numbers. Similar to cannabis, alcohol has also seen a really significant boost from coronavirus. And what we've seen is that consumers are not only going to the staples like the Bud Lights and the Bud Heavies of the world, but they're also looking for alternatives to consume during traditional alcohol consumption occasions. So when we look at the different categories that consumers look at, there's kind of four that we like to think about. And I think the growth of these categories has seen some pretty substantial attention from the market, primarily because today more than ever during coronavirus, people are looking for ways to connect. And traditionally in this country, we connect over consuming alcohol, but there's this inherent conflict for consumers that are traditionally living a healthy lifestyle who want to consume alcohol, which is traditionally unhealthy. So what we've seen is people are looking for ways to interact with other types of beverages during traditional alcohol consumption occasions. And we bucket these types of products into four primary categories. The first is non-alcoholic alcohol. So think zero ABV beers, zero ABV spirits, The next is traditional non-alcohol. So you can look at the brand Huza, which was launched by Molson Coors, which is a probiotic seltzer. You can also look at Super Coffee, which is a coffee company that just received investment from ZX Ventures. And then Better For You Alcohol, which has seen some pretty significant growth over the last couple of years, primarily off of the success of White Claw, which is up 1,000% over the last 2 years from $147 million of retail sales to over 1.8 billion. And then there's some smaller emerging brands like Flying Embers, which is helping pioneer other interesting categories like hard kombucha. And then just to round off that, you are seeing some pretty large non-alcoholic strategics like Coca-Cola enter into the alcohol space. So they just launched the Topo Chico hard alcohol brand in Latin America, and they announced that they're also going to penetrate the US market in 2021 with the Topo Chico hard seltzer brand. And then cannabis, we talked about it a little bit, but many of the large alcohol companies are a bit worried that folks are going to shift from alcohol to cannabis beverages. And we're seeing some of the big boys like Constellation Brands and Molson Coors hedge their bets a bit. So Constellation Brands owns about 40% of Canopy Growth, which is the largest cannabis company in Canada. And Molson Coors entered into a joint venture with a cannabis company called Hexo, which is just recently launched some cannabis beverages in Canada as well. So I think the main takeaway here is that alcohol continues to do really well, especially in the backs of coronavirus, and consumers are trying to figure out different ways to consume during those traditional alcohol consumption occasions. And there's definitely interest from strategics and investors to try to figure out ways to benefit from that. Now I'm going to kick it over to my colleague, Tim Sousa, to talk about Trend 8.
Awesome. Thank you, Greg. Now that we've talked about both cannabis and alcohol, it's time to revert to the true healthy living roots of this presentation and talk about a topic that we just couldn't ignore, which is the rise of alternate protein, and more importantly, the rise we're seeing in the flexitarian diet as well. Now, the shift towards plant-based meat is a long-term trend we've been following at Whipstitch for a good 5 years now. And every time we look at the market data, pull up the IRI data, the trend just keeps getting stronger and growing at an accelerated rate. We think consumers gravitate towards a plant-based diet for really 3 reasons. The first being environmental, whether they're concerned about environmental gases. The second being diet specific, where maybe they have a family member who's experienced cardiovascular disease or some other negative disease that's associated with high meat consumption. And then the third being an animal rights component as well. All 3 of those has contributed to the sales of plant-based meats growing above a 30% CAGR over the past few years. And what we've seen since COVID has started is this number actually increased to close to 40%. And what that points to is consumers becoming evenly more cautious about what they eat as they battle COVID and continue to lower their probability of getting this disease. Another massive trend we're seeing is a shift towards the flexitarian diet. And what I mean by flexitarian is consumers are not ready to gravitate towards 100% plant-based at this time. And it's really just saying, hey, I'm going to eat 75% veggies, 25% meat at the end of the day. 2 cool companies that are innovating around this are Seymour and Raised and Rooted. I think the most powerful statistic that we saw out of all of our research here is that 6 in 10 Americans plan to gravitate towards a flexitarian diet over the next few years. And what that means is the large, billions of dollars from the large meat companies is kind of ripe for the taking from upstart food and beverage companies, and there's ample market share available. For trend 9, we're going to talk about how millennials and the Gen Z consumer are shifting how strategics and private equity firms invest in the category, mainly driven by how and when consumers buy the product and where. So consumer buying habits have changed greatly, and the response from private equity funds and strategics has been pretty profound in that they are going out and buying brands that resonate with younger consumers, the millennials, the Gen Zers at the end of the day. And these are the consumers that matter because they'll be the next consumer for the next 25 years. Purchasing has changed. If you look at the graph on the bottom left here, what used to be a predominantly retail discovery and retail purchasing decision for baby boomers has turned to just 1/3 or 32% of Gen Zers who are actually going into stores and buying the product. So where is that statistical disconnect? That is in online discovery, whether it's influencers, Amazon, Twitter, Facebook, whatever medium you can effectively go out and acquire your customers with. And with COVID, this has become even more profound. That 32% has essentially gone to zero. You are not walking through Macy's, you are not walking through Nordstrom's anymore with salespeople, squirting moisturizer, trying perfumes, things of that nature. And these brands are very, very dependent on your social media platforms for discovery and to create purchasing occasions. So net out of this slide, if you are a young personal care company having a very, very strong, credible, authentic e-com experience and website is going to be crucial for success as we continue to come out of COVID. And I'll turn it over to Mike Bergmeyer for Trend 10.
Thanks, Tim. Trend 10 is a trend that we have highlighted before. I was actually going through the different healthy living reports we've put out over the past 5 years. And if you check September 2019, March 2019, March 2018, September 2017, March 2016, we have continually talked about sugar and the rise of low sugar brands, the need and the desire for consumers to look beyond sugar and look for alternatives. And it's very interesting. In March 2016, we said the sugar problem, alternatives to low sugar and leaders evolve. I don't know if this is going to work, but even we had a picture of the old Spindrift seltzer from March 2016. Spindrift is now, that was probably a $1 million brand at that time. You can check, we can't say what the numbers are, but if you check Spins, if you've got access to it, it's quite a large brand. Maybe Rico can give some more extra data in his presentation. So with Trend 10, we just had to go back to sugar. The low sugar brands are continuing to disrupting food and beverage categories. And I think one of the biggest things is it's just more and more categories. It's everywhere. I was looking at the data this morning. It's quite interesting. Since 1999 to 2020, there's actually been an 18% decline per capita in the US in sugar consumption. We're still a long way to go. The US has the highest, even with that 18% decline, the US still has the highest per capita consumption among all countries in the world. The average US person is consuming 126 grams a day of added sugar. That is 1/4 pound of sugar. That's a lot of sugar. And it's not good for us. If you look, I'm not a doctor, I'm not going to pretend to be one, but if you look at our mortality rates from COVID, clearly the US is doing worse than almost any other country in the world. We all know sugar has a link to diabetes and obesity. Dr. Fauci can tell us the rest. So I think just like Tim was talking about plant-based, and we've gone back to that trend, we just keep going back to this trend because it's real. And if we're still the worst in the world, there's still a long way to go. So you think about the opportunity that exists for brands in the better for you space across every category, the opportunity is immense. And then you also look at the data and you start to see what the categories or the demographics of who is now going low sugar and maybe going there more quickly. It's the younger consumer. So just like the change that's happening in personal care to online in the younger consumers, and that trend and that shift going to have a very, very long-term impact. This is very long-term. 60% of parents are actively limiting their kids' access to sugar content. That we're creating new consumers. My children don't know what a true soda is for good reason. And if you look at beverages, you've got some great brands. Obviously, Waterloo just transacted. You've got Zevia, Spindrift. On the energy side, Rowdy and Guru with some really nice low sugar entrants. On the alcohol side, Flying Embers, Canteen, Hydrant on the hydration side. If you look at ice cream, Enlightened is just making leaps and bounds in growth in low sugar ice cream. If you look into snacking, Country Archer, Lily's doing extremely well. Swerve really leading the baking and baking mix category, and Food Stirs has done extremely well with their keto low sugar line too. So it's really hitting every single category, and we're probably going to come back to sugar again and again over the years because we're still the worst in terms of a country. So there's a long way to go. And that takes us to trend number 11. So at Whipstitch, when we started doing these trends, we kind of say we always go one louder, we go to 11. So we're taking it again to 11. And this has to do with companies, and a lot of the people who are out there growing businesses right now, they're thinking about growing something that eventually someone could buy. You're putting your blood, sweat, and tears and money and time and effort into building something. So you're looking for that exit. How can, at the end of the day, you have that opportunity to sell something? And the big thing here is that exit options, in our view, have never been more robust or diverse. That old adage that if you build a great business, the exit will be there. We think that's true more than ever. But trend number 11 is really about the public markets, because that's what's been different this year. And the public markets have shown a high interest in creating new exit opportunities for consumer brands. And you've seen that in IPOs and SPACs in particular. Obviously with the Beyond Meat IPO has been tremendously successful. I was checking the numbers this morning. The market cap right now is over $11 billion. It's for a company that's still losing money. Laird Superfood, the market cap is close to 500 million as of this morning. That's off, and this is staggering, 5.6 million of revenue in Q2. And Vital Farms market cap is over 1.4 billion, and that's off of 59 million of revenue in Q2, which was up 84% year over year. So clearly there's some good growth going on. And SPACs, this has been described as the year of the SPAC, and that is very true as well in the consumer space. And SPACs are special purpose acquisition companies. They provide an alternative route for companies that are private to go public. That's much less rigorous process than doing the IPO. And we've seen that with Quest and Utz going public through the Collier Creek SPAC, and then Whole Earth Brands too. And then to the bottom right here, you see a whole bunch of new SPACs that have been announced that are in the consumer space. So these are going to be new options, new exit options for companies. But I think one of the most important things, and we've talked a lot about this internally at Whipstitch, is that all exit options are on the table. You've got large, mid-sized, small strategics. And now with SPACs and IPOs, you have new strategics that exist. You have private equity firms. There are platforms out there. You can be a platform or you can be a roll-up. There's a lot of roll-up going on right now, and family offices and other new vehicles of capital are out there too. The cost of capital has honestly and truly never been lower. And a lot of the strategics that have had a boost in sales from COVID this year, their balance sheets have never been stronger as well. So that just leads to more cash as well that's available for exit options. So we are strong believers in that there will be a very strong and robust M&A market that will continue in the better for you consumer space for quite some time. And that concludes our 11 trends. Obviously, we have a lot of fun internally debating these and talking through them in the month or so leading up to when we release this report. And obviously, there's many other trends that don't quite make the cut, and but we see it in the data. And then speaking of data, we will now hand it over to Enrico Rena, who's part of what we call our advisory group at Whipstitch Capital. We call the Stitching Crew. And Enrico and Spins in particular have been great partners with Whipstitch. And so what Enrico is going to go through right now is just a snapshot again of what will be in the full report that will be available via email following, on our website later this evening, coming out by email tomorrow. But Enrico is going to go through a little bit of the data that Spins has and is providing for us today. Take it away, Enrico.
Thanks, Mike. And those are some fabulous trends happening. And I think as we start to get through this back half of this section here, you'll start to see a common theme across all of those boards. So as we move on to the next slide, please. Want to first just kind of give a quick overview of Spins. You know, we're for those of you that are not familiar with us, we're a mission-driven company that's been around for over 20 years. Spins is empowering not only brands, but our retailers and various other partners, utilizing our information that we have to help focus and drive insights, to build meaningful relationships, and continue to grow the industry through our data. As we do that, you know, there's a couple of components that we really focus in on that make us differences. Spins is kind of that center hub of the ecosystem when you think about who we network and who we work with. Spins, you know, works with retailers to help them with category management, along with brands to help drive their growth, brokers, distributors, investors, as well as strategic partners. So we're kind of that common language that connects everybody together. When you think about what makes us different, is Spins has a lens of view to unique retailers. We have a proprietary channel called our Natural Enhanced channel with a variety of proprietary retailers, as well as some other new retailer channels that we've just released this year around regional grocery and neighborhood pet channel. We've been over 20 years been coding for health and wellness, so we have the most in-depth product intelligent library around where you think about the wellness products that are scanning there within all of our retail partners, as well as our natural consumer segmentations really help us drive down to what is the natural consumer looking at today. Lastly is our comprehensive coverage for the marketplace. Spins not only does the progressive shopper, where we move to the mass shopper as well, and so we cover not only natural but conventional retail as well through our partnership with IRI for the long term. So we can give that unparalleled view across all markets when we look at the data. Thank you. The last thing here, just before we get into macro trends, is what's near and dear to my heart across the board is that Spins has solutions that are help investors to, you know, find, analyze, and invest in winning brands. We built a suite of reports fit for purpose for investing, desktop version across all of our categories and channels. When you're away from your desk out at trade shows, when we get back next year, hopefully, there's an application that allows us to look at data while you're on the fly. We have a tremendous team on the background that does excellent diligence work if you're in diligence, and then we also do a lot of support with the portfolios within each of those firms that are out there. So a really great solution to move forward with. So let's get going into the state of the natural. Have a few slides on the macro trends, and then we'll get into a couple of more of a deeper dive. So as we look at the CPG world in whole, one of the unique things that Spins offers is this unique lens into these channels. And here, for purposes, we looked at natural and conventional. And on the left-hand side here, you see our breakdown. What Nick was talking about a little earlier is natural products versus specialty versus conventional products. Going to call this our Spins game board. Across all of CPG and growth, we're seeing growth across natural and specialty products. You know, as people are cooking at home more, we're starting to see a lot of growth, but the growth is really still continuously happening through natural products. Slide. You know, when we look at, you know, continued growth in natural, I mean, when we think about the products that are out there, folks and consumers are really starting to, you know, focus on better for you brands, right? With the height of COVID, immune boost, and things of that nature, where really folks are leaning towards natural products to help supplement some of those things to continue to maintain healthiness. As well as on the conventional side, we're still seeing strong growth in those conventional with folks that are, you know, pantry packing at home, as Nick mentioned, you know, buying freezers and packing them up as well on the conventional products, as well as, you know, switching from some of those maybe conventional products that they like and trying and sampling some of those natural products that they had an eye on and thought now it's time to try those other products that we haven't had a chance to do in the past. And then when we think about, you know, the consumer and how things are shifting, and one of the unique attribute characteristics that Spins can do is really dive into attributes and look at how the consumer is shopping, not only from a specific brand standpoint, but what's helping to drive some of those growths. And as we think about, you know, that at-home cooking and the better for you and immunity boost, you know, a couple of things stick out as we continue to see growth around some of the key attributes, but it's starting to mix into the mass channel as well. And one of those is, kind of driving a lot of growth here is, the plant-based positioning and plant-based products, as we talked about a little bit earlier. Those are continuing to see a lot of growth and a lot of happening across the channels. And then we get into like immunity, and there's a lot of different things as we start to focus in on our health, COVID, upcoming flu season, right? How can we continue to build better immune systems up? And elderberry, vitamin C, zinc, some of those things that we can be taking at home to help compensate some of the other things that we might be doing around food. So it's funny because I think this morning I had a majority of those things on the right-hand side of key items on my counter when I woke up. My wife, as we're getting close to the colder weather here in Chicago, and I have 3 little ones, they were like all laid out on the counter for everyone to take this morning. So I thought that was kind of funny across the board. Next slide. As we look through, a couple of key takeaways before I dive into 2 key topics is, we're seeing historical growth across channels. Consumers are looking for better for you brands, healthier alternatives to what they were eating before, and also kind of somehow relying back to some of the things that they used to be purchased in the past, as either budget conscious or whatever they might be looking at. The conscientious consumer is still there. They're still thinking about, what's better for them and what's better for the environment. How is it impacting animal treatments? Is they're doing other things to support the growth of the industry? And so the consumer is much more conscious of the products they are buying in the marketplace, which is leading to brands to become more innovative in the products that they're releasing in the marketplace. So as we talk about, plant-based is the big one, is we look to continue to see growth there. And pet, there's a whole avenue of opportunity within the pet industry to continue to expand beyond conventional products that are out there. And immunity is still top of mind. As we get into the flu season as well, potentially second wave of COVID, right? Everyone wants to make sure that we're doing everything possible to keep not only ourselves, but our family and our friends healthy. And how do we continue to do that and look at new opportunities to get resources to continue to expand those opportunities to be healthy. We can dive a little bit more into plant-based for a few slides here. Just kind of a bit of a teaser to what's to come in the full deck. But as we look at plant-based, we see double-digit growth across over the last couple of years, and it continues to grow. We typically see a lot of growth happening still within the plant-based milk and dairy products, but there's also a huge spike in refrigerated plant-based meat and meat products out there. So we continue to see a lot of growth happening on the alternative meat section within plant-based. We go across the store. Again, perceived in the past that, plant-based was really around in the dairy and refrigerated sections. And, it has expanded. It's expanded across the footprint of the stores. You're into plant-based meat snacks, replacing some alternative meat, the snacks that we saw before, alternative meats with good catch in the, shelf-stable meat sections in the retailer. So it's going beyond and beyond, and as folks are looking for better for you brands and better alternatives, they're really kind of expanding and finding new opportunities outside of what's traditionally been the stronghold for plant-based products. Along with that, as plant-based continues to, grow as a category, as I saw on the last slide, across retailer, it's really been driving a change around the products that we've had and what we've seen in the past. There's been an emphasis on better tasting products, the texture being more like our conventional meat partners, and then growing those opportunities with nutritions that are backing them to continue to provide the amount of protein that you'd like to see. You think from a packaging standpoint in creating newer taste profiles in the marketplace that you traditionally haven't seen before in the plant-based world, continue to expand those opportunities and drive more consumers to try plant-based products. As we think about trends to watch in the marketplace, protein continues to still be, a thing that our consumers are looking for within their products. They want that same level of protein that they're receiving through their meat products. And so that's driving our plant-based partners to really look at alternative ways to continue to source plant-based products to get up to those parity or exceeding the amount of protein within their products. It also helped eliminating, cutting down on carbohydrates and sugar as well in a lot of these products to really gear towards a more healthier lifestyle and not packing so much within there. Then when you think about clean labeling, as well, that's still on top of mind for folks. When you traditionally thought about maybe plant-based products or alternative products, there were, folks will assume that there was just a lot of fillers within these products. And how do we start to clean up the packaging to ensure that consumers are getting better for you products? So a couple of ingredients that people are swapping out, and they're adding nut butter, avocado, mushroom, and oats to their products versus what's traditionally been in the fillers in the past. And then, as Mike mentioned before, sugar, right? That's just one that we have to continue to try to eliminate and lower the amount of sugar in all of our products. The last one here kind of segment is pet parity, right? As we start to look at opportunities within pet, a lot has shifted, right? We've seen slides like this in the past in presentations. There's a shift from conventional to the natural type of products, right? So when you think about dog food, it goes from, raw food now, replacing some of the potential other products that we had. No high cues versus what's out there in the marketplace today. And then more eco-friendly waste management products for dogs. So, we see a shift. It's just as we saw the shift in years past with the consumer segment, with food and beverage, shift of profile and taste, we're starting to see our consumers, make that shift to our animals that we love so much. In the pet world, right, it's still prominently dominated by conventional products in the marketplace today. There's a lot happening and change. Spins has released a new neighborhood pet channel, and we'll continue to see growth and changes within the way the consumers are shopping and looking at the pet industry. Again, we've been coding for quite some time and then on the natural product space for food and beverage, and we continue to take those industry learnings and apply to the pet industry and continue to help those drive change from conventional to better for you brands as we look to better our health, not only for ourselves, but our loved animals that we have in the market. So we'll continue to see those growths. Lastly here, as we think about, with the enhancement of the neighborhood pet channel, Spins has started to code out attributes to really help to understand what's driving growth and what opportunities are looking at moving forward. So when you think about, in dog food, naturally positioned products, so we can easily define what a natural product is versus a non-natural product. We think about grain-free in raw hides and animal chews, raw positioned, dog treats, and you want to dive even further and understand what's driving growth within dog treats. You can look to the gluten-free, raw position, grain-free, and et cetera. Vitamin supplements, we look at probiotics, CBD, how does that continue to drive growth within these segments? So there's a whole new avenue as years pass where folks got educated on food and beverage. We continue to look support around educating the pet channel, our pet lovers, folks that are in the pet industry to really help them understand what will be driving growth in the future. There's the business of today where we saw with very heavily conventional product position items. We're going to see a big trend of moving to natural and specialty products within the pet industry as well.
All right, great. Thank you, Enrico. I love that last slide because it has a puppy and dogs on it. I told Enrico when we were going through the practice that I learned something. You should put a puppy on every single slide. It's probably an easier way to raise money and sell a company. Well, I just wanted to thank everybody. We're gonna stay and do some Q&A here. So I'd ask everyone on the panelists here to unmute yourself. So and hopefully it doesn't get echoey or bad, but we've got some questions that have come in. So feel free to keep sending them in as well. I did want to though take the chance to thank the rest of our team. We have got some great analysts on the team too. Tom, Sarika, Brendan, and Tyler just did a ton of work and help in getting this together. And most of all, I have to thank Kathy Foster, who's the head of operations at Whipstitch, and she's really the backbone of the organization who made all this possible. We are not tech wizards, and Kathy helped us figure this out and helps us figure out everything. So thank you, Kathy. Again, all of these slides actually in the larger format will be available on our website later tonight. If you go to on the top banner, you'll see a part that says Our Take, and within that there's a drop-down menu and it says Healthy Living Industry Updates. And then so we've got them going back about 5 years, well, full 5 years. And this one will be there this evening. And then we'll also be sending this out to the email blast, our database tomorrow. So we do have a lot of questions that have been asked here. And Nick, I know one, and I'll have everyone kind of jump in general. But there's been a lot of questions we've heard about the COVID bump, the increase in sales that a lot of companies have seen. And certainly, Nick, that was one of your slides. There are certain categories that in particular have seen a real increase in sales. And then we had some interesting comments that some people made too. Sometimes when a mainstream brand may have been out of stock and you were a secondary brand or option maybe to begin with, it provided that opportunity for new trial as well. So a lot of questions that we've heard, from, clients and companies and people out there is, what does that bump mean for my company longer term? How do I measure what's real? Can I get credit for it? How much credit can I get for it? And I know you've done a lot of thinking. We've done a lot of thinking about that internally, but love to hear some comments and have a little conversation about that, this COVID bump and what it means for a lot of companies.
Yeah, it's actually a really tough question because the post-COVID performance for every company in every category is so different and so full of noise that there's a number of factors that you really need to dig into to try to figure that out. And I think for every company in every category, nobody can be certain what's the new normal and what are your sales going to look like in 2 years. But things that we do look at are, my favorite thing is to look at the latest 4 weeks, just because that's the freshest data. And if you compare to last year, what is the velocity increase in your brand? Dollars per TDP in spins is a great measure of that. And you can look at the category. Has the category grown against last year? And a simple assumption is that the growth in the category is a proxy for category velocity increase, which is a COVID bump. So if a category goes up 10%, it's likely that it's mostly COVID bump. If you're looking at something like plant-based cheese or something like that, that's in a secular growth rate right now that's faster, you actually have to look at the last 2 years because it might have grown 10 or 15% looking 2 years to last year and 30 this year, which means your COVID bump is 15 that you need to compare against. So if you look at your velocity increase against that bump, that's a really helpful factor. There's all the other things that come into play, like how fast are you expanding ACV? The faster you expand ACV, the more you dilute velocity. It's just, it's just something that happens, and you kind of have to think about that. And then is there evidence that you are actually growing the category or something like that when you look at the performance of the larger brands in the category compared to you, because categories are shifting too, and that's a very, very helpful fact. So I don't think you can kind of get it down to a number at the end of the day, but I think if you're talking to investors or you're sizing up what your growth projections look like for a big strategic buyer, you need to consider all of that to make the best case.
Yeah, no, it's all very true. So we've got a lot of questions, so we're not going to be able to get to all of them, but I want to start to throw some out there to everyone. One question was kind of our thoughts around the D2C movement in the alcohol space. And Greg, I know you've seen a lot there, and we've seen some new companies that have almost started in the alcohol space solely based on direct to consumer. And our client Flying Embers has done a remarkable job of kind of moving very quickly and adeptly into D2C and a lot of delivery. Drizzly raised a ton of money recently too. But Greg, what have you seen in the D2C movement in alcohol?
Yeah, I think you're seeing a shift more broadly in DTC outside of just alcohol, but kind of talking about alcohol specifically. One of the main benefits is that a lot of the states relax some of their DTC alcohol laws in the wake of coronavirus to help some of these businesses. And Flying Embers was one of the beneficiaries there. So prior to that, they were unable to actually ship their products directly to consumers. And now they're able to benefit from some of the same direct to consumer advantages that other brands outside of alcohol have been able to benefit from over the past, call it 5 years. I would say that over the past, call it year to 24 months, we've seen the direct to consumer channel more broadly leveraged by many food and beverage brands, both alcohol and non-alcohol. And the way that investors and strategics are viewing this category is as kind of a specific channel that brands can sell through. So it's a way to have a direct conversation with your consumer. You can ask them questions, you can test products, ship them directly, try new flavors before you're actually commercializing them and shipping out more broadly to many more channels in the grocery space. And what we've seen is that people really care about that consumer relationship and knowing your consumer. So while we've definitely seen kind of a cap on the amount of revenue that you can generate through that channel, there's much more sort of value that you can get outside of just the revenue dollars. And you can use some of those findings to increase the value of your business by selling products through other channels and better understanding your consumer.
Mm-hmm. Yeah, no, we've been doing a lot of work internally here at Whipstitch on the direct-to-consumer channel and the dynamics and D2C only companies, and obviously looking at a lot of the brands that we see that traditionally are brick and mortar and expanding more into e-commerce and D2C. And it's interesting that I know the term omni-channel, we talked internally 2 years ago, was almost a out of vogue term. It was something that investors didn't want to hear. Now, if you're not omni-channel, you're really missing the boat. And it's just incredibly important to see how all the channels work together. Tim, there's a question might be for you, because I know you played a big lead on our transaction this past summer when we sold Thayer's Natural Remedies to L'Oreal. Someone asked about the deal dynamics in beauty and how different they might be from food and beverage, specifically in terms of stage, multiples, and just, I assume then the kind of appetite and interest in companies.
Yeah, it's a great question. And I'd say the overarching theme is they're quite similar, right? So investors and strategics are trying to acquire younger brands, which again, resonate with Gen Z and Millennial customers that have high velocities and high gross margins. So I think the corollary between food and personal care here is, velocity and margin are kind of the two biggest things you'll need to focus on if you're building a kind of young and innovative company, and just prove the repeat purchase rate. But the basics of the businesses are very, very parallel.
Yeah, no, totally agree. Nick, I know you've been in the data too, and Enrico, this might be for you too. Someone asked about, are we seeing price points on the shelf coming down on better for you products? Or are they still kind of only accessible, for those with higher incomes and just more ability to spend?
Yeah, that's a great question. To be honest, I don't thumb through all of the data to look at all the price points for, by category and areas. I know with retail today, there hasn't been a whole lot of what you're just seeing going out to the stores is right. Not so much promo happening at retail, because what you're trying to stock shelves, get things products on the shelves at retail. So prices are been what I've seen just visually walking stores and being out there. Prices have been kind of flat without having a lot of the promos that typically happen in the market today. So. And just a lot of, that's happening with category buyers not having meetings that they typically would have and setting up all those. They're just not running those as frequently as they used to.
It's actually a really good question. It's actually something that now I have to dig in and figure out, because you've sparked my curiosity. But
I saw it coming. I was like, that's Nick right there.
No, I gotta look. But last week or the week before, we actually ran the data. And we saw in trade spend, if you looked at dollar promo indexes from February over the COVID period, that the large companies were faster to get rid of their dollar promo. So in other words, they were faster to go off promo, which would mean their price point was higher, We didn't measure price points. We looked at dollars promo and spends. And that in the last couple months, the smaller companies, or I should say really the HWI and NPI categories have over-indexed the TPL, which is again, everything. So this is just the healthier brands, which I guess would technically tend to be the higher price point ones, have actually over-indexed in returning to trade spend.
Yeah, maybe we'll just do one or two more because I know we talked about doing this for an hour, but if people need to drop, they can drop. But there's still kind of well over 250 people on, so we'll keep going for a few minutes. One question is about the food service channel and looking at different growing food categories, food, beverage, you got e-commerce and retail that are growing, and obviously food service has been hit very hard. And then Nick, I know you spent a lot of time in the data there too. And the question was how should food brands view the food service selling channel, post-COVID, during COVID? Should they avoid it? Does this channel scare investors? And before I guess you answer, it's I think one interesting thing, we're in regular dialogue with over 50 strategics or so every month or so. And it's been very interesting, both of the strategics and a lot of companies we've talked to. Obviously, a lot of companies that had food service exposure were very hurt from that. Those sales, didn't necessarily, in some cases they evaporated, but they definitely slowed down. But obviously other channels, they saw a strong increase in sales. And in a lot of cases, you have companies that may have had 25% of their sales exposed in food service are still up. But it's because they had the mitigating factor of not just being reliant on one channel or another, which maybe gets back to the whole importance of being omni-channel in some ways. But Nick, what have you seen? I know you've jumped in the data more than anybody here, I think, on our side.
Yeah, it's, so I feel like if you're building your company to be over 100 million in revenue with a view of selling to a large CPG, the biggest channel for validation is going to be conventional grocery, MULO, Club, Natural, those type of things. But at the same time, the question is, how do you get people to try your product? And I mean, Mike, you brought up Spindrift before. Spindrift started with a fresh juice soda, and they were heavily in food service before they were in Whole Foods. So if you're going near, are getting fast casual and you're buying Spindrift for $2.99, and suddenly it appears at Whole Foods at $1.79, it looks like a bargain, and you've already got some mind share. So I like branded food service kind of any way you can do it, just because it builds mind share. If you're growing a product for profitability, thinking it's going to be something that you're going to liquidate when it's 40, 50, 70, whatever million revenue and 10 million EBITDA, food service is a great cash producing channel because it tends to be kind of step function business and a very efficient distribution compared to going to grocery. So I think in either case, it's a win. It's just a question of if you can do it branded or not.
Yeah. And I'll throw this one out to everybody. And I think there's a couple of dimensions to this question, but there's a question about data analytics. And let's think about it in terms of acquirers and both investors. But I think more acquirers, because they're going to be a little more data heavy on looking at the kind of the consumer. But if you think about data analytics and acquirers, and they're looking to make these acquisitions, how do they think about? The question is about thinking about the lifetime value of a consumer and coming in. And Dom, Tim, Greg, love to hear your kind of thoughts. I know you guys have spent a ton of time looking at lifetime value in terms of D2C businesses, and some good ways it's measured and poor. But I think another way to think about lifetime value is just who exactly that consumer is. And Rico, I know we've worked with you and Spins on this a lot of times, looking at panel data, like really trying to fully understand who the consumer is for a particular brand. It's just so important to know your consumer. And that's exactly what the strategics are going to want to know too. It's incredibly important with Thayers. We're seeing that at other times too. Ethnicity, age, demographics, married, not, income level. Are you growing a category and taking share at the same time, and to what extent? If you are a true millennial or younger generation brand, it kind of speaks to the whole thing about being a lifetime value, because you're going to hopefully be acquiring a consumer who's going to buy that brand for 30, 50 years. It gives you that permission to extend that brand as well. It's just really important to get into the data analytics. And I know we spend a lot of time with that, but I throw it out to you guys, because you guys have been on the front lines of, you know, gathering a lot of this data and analyzing it.
Dom,
Yeah,
you wanna start?
Yeah, I'll start. So in terms of, I guess, measuring the lifetime value of customers, I would say it does seem like the secret is out across both strategics and investors right now, that you do need businesses that can acquire customers across multiple channels. I think, you know, if you look 10 years ago at the early days of direct-to-consumer brands, there was a real kind of inefficiency in terms of marketing costs, where you could leverage Facebook, Instagram, Google, etc., to get some real cheap advertising to acquire a lot of customers at a very, you know, low dollar rate. However, as other brands caught on to this tactic, those costs have gone up. And I would say, generally speaking, the cost of acquiring customers over time purely online has kind of reached a breaking point where it's hard to be, you know, first order or second order profitable. And so what all investors and strategics are looking for from brands is that they're able to spread that cost of acquiring a customer across multiple channels. Because even if you know, let's say you're a salty snack brand and you historically have only acquired sales through online, that shopper, that consumer is still going to the grocery store every week, or the, you know, wherever it may be. And if you can now be both in front of them online and in the store, that just creates the opportunity for them to continue to purchase your product. So I would say, in terms of spreading the lifetime value across multiple categories or sales channels, that's very much imperative in terms of a long-term strategy of a business. You can definitely start online, but you do need an approach to get offline at some point. In terms of, I guess, understanding the consumer, does anyone else have any thoughts on that? It's incredibly important, and there's various data sets to do it. Again, as Greg mentioned earlier, direct to consumer allows you to have direct communication with your customers, which no other channel necessarily enables. And it allows you to do quick surveys or whatever it may be to really understand who is buying your products, and you properly leverage that data to find more and more of those like-minded consumers. And that's, as Mike said, incredibly valuable insights for both.
Yeah, I guess the one thing I would add to that is that it's not as expensive as you might think to access panel data and do a good study and find out exactly who your consumer is. You know, instead of putting out a deck that just says we have a younger, healthier soccer mom customer, because everyone knows you haven't done any work when you say that. You know, you just stole the slide that was on 30 other decks. But if you truly do know your customer, you've got some strong information. And when we've sold companies, you know, you don't want to be in the kind of situation where the acquirer comes into the meeting and they know so much more about your business and your consumer than you do. And it just demonstrates a bit of naivete, you know, about running the business. So I think early on, it's important to try to access that data so you can also just run a better company if you know your consumer.
Like you mentioned before, I think, you know, Spins does a nice job. We have a really powerful consumer panel team that does a lot of great work in this space. Adding on to the layers of, like you said, demographic profiles, knowing who your consumer is, you know where you're sourcing your volume from. That's a big one, especially for some of you emerging brands that are out there. Where, you know, strategics want to know, anyone's making an investment, where is that volume coming from? If it's another like brand, runway is not as long as it is from a bigger brand. You know, and brand switching too.
Yeah.
Especially in some of those earlier stage brands too, you know, we talked about this, not so much happening today, but as we get back to normacy, right? The trial repeat studies are really important to understand, you know, how many of those consumers are coming back and purchasing your products. And that's all done through consumer panel and knowing your consumer and who they are.
Yeah, important points. Well, I just want to respect everyone's time. We've gone about 10 minutes over. I wanted to thank everybody for joining us today. We had about 400 people join on the presentation today. We all miss seeing you live and really wish that we had been able to deliver this report 2 days before Expo East and have seen everybody there. But, you know, if everyone, you know, stay safe, wear your mask, you know, eat healthy, get sleep. what I've learned is I don't like travel as much. 8 hours of sleep is a great thing, and you really can eat healthy and exercise. So thank you to all of us from Whipstitch Capital. Please stay in touch, and good luck out there. Stay safe. Bye.
Thank you.
Bye.
Awesome. Thanks, everyone.